Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Paul Podolsky, former Bridgewater Associates portfolio strategist, and now the founder of Kate Capital and Still Press.
And today Corey and I will talk about Ben & Jerry's and the Fed and whatever else is on our minds.
And remember, if you want to get in touch with us, send a note to feedback@investorhour.com. Tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. I don't want to spend too much time on this, but let's talk about the Ben & Jerry's thing because there is a point that I have to make here. Of course, the Ben & Jerry's thing is that they tweeted on July the 3rd. The tweet says, "This 4th of July, it's high time we recognize that the U.S. exists on stolen indigenous land and commit to returning it." Then it says, "Learn more and take action now," and gives a little link to click on, which I didn't click on because I don't care. It's not that I don't care about indigenous people. It's just that you could argue every inch of the country is indigenous land that was stolen, or, that's just the way history has worked out. I mean, can you imagine if we tried to give everything back to everyone like that? We would be, how far back would you go? Would you go back 200,000 years? I don't know. I have no idea. All of those efforts are misguided. Reparations and all the rest of it. It's all entirely misguided. And so in the ensuing few days here, the S&P 500 lost about 0.9% and Unilever lost more than 2%, like $3 billion in market cap. So I was realizing something like Target, Disney, Anheuser-Busch, Unilever. It used to be that we just sort of tolerated what we might call woke politics or any type of political statement by any corporation, right? People just kind of rolled their eyes. They just said, okay, whatever, and continued buying the product. Nobody really took it seriously. I'm not saying boycotts didn't exist for various, boycotts have always happened. But it seems like this sort of thing is getting harder and harder to get away with, and people are more serious. They're seriously tired of it. And, they sell the stock and they don't buy the product, especially like in the case of Bud Light. That one, I have to say, really surprised me. And Target, they're boycotting Target. So this is becoming, it's really impacting business. And, it'll probably, Ben & Jerry's like 900 million in sales, according to Statista.com. And that's like, Unilever is like 60 billion in sales. So less than 1/60th, right? So overall, I think, the business will probably be fine. People will still probably eat Ben & Jerry's ice cream. They'll get past this, et cetera, et cetera. But it seems like these sorts of things keep happening and keep making a dent in people's real behavior.
Yeah, it's interesting. A few different angles to these stories. Ben & Jerry's, Bud Light, others, Target, like you mentioned. I think there's been some others too. Like none of them work out well for the companies. I like politicizing products just doesn't seem to go over well with at least people who are in the markets. There may be people that work at those companies that are in favor of those things, and it may, boost some employee morale or maybe something like that. But like when it comes to stock prices and business, I think the lesson is politicizing stuff that doesn't need to be politicized generally doesn't work out too well, I think, on balance. It's like, and I'm not saying anything's right or wrong. I'm just saying, like, when the vocal minority wins, the silent majority gets if not upset, just more apathetic about whatever cause it may be. So I think that's what you're kind of seeing play out there. With Ben & Jerry's, with Bud Light, like I saw somebody drinking a Bud Light the other day and I was like, whoa, are they making a political statement now? Like it's just stuff you don't really want to think about. I think most people don't want to have to go through the day thinking about whether they're being judged for doing something right or wrong. Like if you shop at Target, you just, you're looking just to buy like everyday essentials
Yeah.
that you need. Like it's not like whatever.
Right. Right. You don't want to make a political statement. You just need to get stuff. You have a
Yeah,
life
I
to
just
live.
need
You're
milk.
busy.
Yeah.
Yeah. That's exactly right. I have to say, my greatest disappointment with all these things is that they're not better buying opportunities. Really. I wish like Unilever owns 400 brands. They have, a lot of great brands under their belt. And if one wanted to buy such a thing, which wouldn't be a terrible thing to own for the long term, I would think, you would kind of want there to be, as Warren Buffett might put it, this one-time solvable problem. And I just wish it was a bigger problem because, you know, if I want to own the stock, I want to see the problem look like it's a disaster, but not really be one. And in the case of, I'm just looking at charts here. I've just got them all in one chart. Anheuser-Busch, Target, Disney was another one impacted by this. Unilever. I mean, the worst one-year performance is Target, minus 12%. And the best one-year performance is Unilever, is plus 10%. Bud is about flat, and Disney is about minus, just call it 9%. So I don't know. They're all within, like minus 12% is the worst of all of it. I don't know. It's a non-event, and if you still want to buy any of these stocks, I think you should. I think that's my conclusion. I don't know if I have a lot to say about the Fed. We normally do, but it just seems to me, looking at the FedWatch tool from the CME group, that the highest probability, like 95, basically 95% probability, is for a 25 basis point hike at the next meeting. And then if you go each futures contract out to March of 24, the highest probability remains, basically 25 basis points above where we are now. Then starting in May 24, the highest probability is right where we are now. In other words, hike, several months go by, then next May we cut 25 basis points according to the futures market right now. But as you and I were speaking before we hit the record button, this tool doesn't really tell you anything about the future, does it? It just tells you what people are thinking right now. And I think the primary use of it is to find out how wrong it is.
Right. It gives you the kind of consensus view, I would say,
Mhm.
which, yes, has been wrong for as long as I've been paying attention to this
Yeah.
thing closer the last couple of years, year plus. So
Yeah.
it's it has no predictive value when it comes to predicting things. It just shows you what the sentiment of Fed thinks. The more when I saw the market react to these jobs numbers last week, and then I think of when the Fed keeps saying they're data dependent and they're waiting to see the impact on the economy now. What they're talking about is is jobs, and what the market's looking at is jobs most
Mhm.
closely. And
Mhm.
so I do think there will be maybe some volatility the next couple months as the read on the jobs market gets clearer or shows some sort of trend or not a trend or whatever it shows. Um, I do think that there's uncertainty in the market as far as when the timing of any job market, like kind of significant weakness, will happen, which has been kind of the story of the last year, really. And after people got past the shock of the rate hikes.
Yeah, I keep thinking about Paul Volcker and 1980, and as I've said, shoving rates back up to 20%. And I'm looking at Bloomberg data. I've read elsewhere it was 19%. Um, but just call it 20, and 4 times. Like, up to 20%. Okay. Is he looking at some data or the market reaction? I don't know. And they, okay, back down to like 10, 15, whatever. Nope, back to 20. Okay, back down. Oh, nope, like 4 times. I mean, an extremely high level 4 times. And these guys are sitting there in Washington right now saying, let's pause and then let's do a 25 bips hike or something. I mean, it's just like, if they want to have the effect that they claim, which is to target 2%, which I totally disagree with. I think it's insane. They're not there yet. And why not just beat it over the head? Like, we know what has worked in the past, right? You got to jack rates up even higher than you think. And then you get the effect that you're looking for. And then you can bring them back down. According to there's not a lot of these episodes in history.
Right.
But I don't know, according to the last big one.
Yeah, the longer you look at this data with like the inflation data, it's coming down, but slowly. What the number the Fed looks at, the quarter PCE, the pace of it's slowing. Like the longer it goes on the way it is, I think the higher they'll eventually have to raise rates anyway. So I know everybody wants to like freak out over 0 to 5%, but that seems like nothing. Obviously, it's been. I mean, some of the tech companies adjusted to it, but it hasn't really hit the majority of the economy yet. I mean, and I think another interesting point is I saw, mortgage rates are over 7% today, 30-year fixed mortgage, which obviously discourages people from buying and moving around. But a huge chunk of people still have mortgages below, say 4%, 3%. So that the
Exactly.
higher rates aren't having an effect on that. Like those people are just, if anything, that's like inflationary. Like if you're staying in a low mortgage while rates are going higher, that's inflationary for people who are okay with staying where they are and not paying $1,000 more a month or whatever it is, an interest on their mortgage. So
right,
I don't know. I think it's got a long way to go still.
Yeah, they're long-term contracts. I mean, I looked at the yield from the iShares MBS ETF, mortgage-backed securities ETF. It's like 2.73. I mean, it'll tend to be lower than the prevailing rate, but according to Bankrate, they publish these like national mortgage rate numbers, and it's like 7.3. Or let's say 7.3. So it's like, okay, I guess there's some catch up to play there. But yeah, that I think for now though, we've talked about this, that phenomenon of hanging onto your 3% mortgage. It just crimps the supply and keeps the housing market less well supplied, and keeps prices supported, and provides people who really, who can swing it, to an incentive to say, okay, well, we better get our 7% mortgage while we can, because it might be 10 next year.
Yeah, which I think might be true the way we're going.
Yeah. All right. So I still like home builders anyway. But mortgage-backed securities, not yet. Wait till you can get enough of them to create enough MBS yielding 7, 8, 9%. Then they get interesting. And in that respect, to be fair, like 2-year treasuries are interesting at 5%, which is really amazingly cool. Like for years and years, you couldn't get anything. Like a normal person trying to build a portfolio, like they couldn't build it on and there's no safe return. You can't put money in a bank account. You couldn't put it in treasuries, but now you can do that. So I think that's like one of the best things that's happened in the past year, is the rates went up so people can start getting better returns.
Yeah, and if you think about the quote cash on the sidelines, right? Making more money than ever, even if it's just sitting in a money market account, or if you're in T-bills with extra cash, is that disinflationary? If you feel like you have more cash on hand than you did in the last 15 years, I mean, or if it's growing, even if inflation is still eating away, like, I don't know, it's a lot of stuff that a lot of people haven't seen before, I think, including myself. So I'm still trying to figure it out, but I do like 5% interest rates on low risk cash holdings for sure.
Yeah, I think the 2-year was 5%, and the last time it was 5% was like 2007 or something.
Yeah.
That's
Yeah, it was
fairly long time.
Yeah, before the financial crisis was the last time.
Yeah.
But then if you look back at that, like it was all higher way before that. So in the 2 decades.
Oh, sure.
Yeah, like we're not in like crazy uncharted territory here, as much as it may seem to a lot of people.
Right. I still feel like there is a ways to go, but I don't know. I think it's going to wind up shocking people. I think the level of rates has the potential. I won't guarantee or predict anything, right? But it has the potential to shock the hell out of people 6 to 12 months from now. And they're looking at these 5 handles on Fed funds and 2-year and everything, and they're saying they're getting used to it, right? And then a 6 will be like whoa, and a 7 would be like holy. It just, and that's one of my fears. Overall, of course, I want things to be cheaper, and I want the market to be priced for better returns. So I want lower prices, higher cash flow yields, higher yields of every kind, but they're still not there. And getting there, I think, like getting there doesn't have it's not going to be painless. That's my fear. Like I like 5% 2-year treasuries, but man, getting there, I just I worry about that with folks. Anyway.
Yep.
Dan's worried. Yeah. So what?
Dan's worried. No, there will be consequences. I mean, we saw it with just the banks, earlier this year. The worst banks were, got in trouble fairly quickly. So
yeah,
say interest rates double from here, there's going to be a lot of people caught off guard. Yeah.
So we've covered a lot of ground today, and I think what can we sum it up? If you want to buy Disney or Target, or well, maybe not Disney, we said, but Target or Unilever or any Anheuser-Busch or whatever, if you want to buy them, I don't think you should worry about the woke political problem. And still like housing, love 5% 2-year treasuries. Boy, we did cover a lot of ground. Good for us.
We did, yeah. I would just say buy your milk wherever you want to.
All right, well, let's talk to somebody who might have some ideas about this and some other things that we'd like to hear. Today's interview is with Paul Podolsky, formerly of Bridgewater, now of Kate Capital, and I really enjoy reading his Substack. I enjoyed meeting him at the ValueX Vail conference, and just can't wait for you to hear our interview with him. So let's go ahead and do that right now. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. And he just gave them a dire warning. Mark says we're about to witness a historic stock market shakeup that could soon create devastating losses for investors who don't know what's coming. As a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history, and he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. If you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at www.rollingcrash23.com. He includes the name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of beloved pet brand Chewy before it fell 45%, tech company C Limited before it fell 66%, furniture company Wayfair before it fell 76%, social media favorite Snap Inc. before it fell 36%, and food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the famous FANG stock fell 35%. So you'll want to avoid the stock in his new report immediately. Again, simply go to www.rollingcrash23.com for your free copy of this new report. Paul, welcome to the show. Thanks for being here.
Thanks for having me.
So I'll just let our listeners know that we met at the ValueX Vail this year, and I found, of course, as soon as anybody says, "I used to work for Bridgewater," like, everybody wants to hear the stories of what it's like to work with Ray, and you did go through some of that. And we had Bob Elliott on the show, and I had to go through that with him too. But I did wanna touch on one thing for our listeners' benefit. You talked about his work ethic, Ray Dalio's work ethic was like, and look, you yourself have been around. You've seen some work ethic in your day, right? But his just stands out, and I wonder if you wouldn't mind describing that before we do anything else, to our listeners, because I think it's important.
Sure. So I worked closely with Ray for many years. He was actually the person who interviewed me. Bridgewater was small enough when I joined, had about 140 people. That in those days, Ray did the first interview of everybody, including me. And this wasn't just like, "Hey, how you doing?" type of thing. It was, I think we spoke for 90 minutes, and it started off with, 90 minutes on a prospective interview that he didn't even know if he was gonna hire me. And so that is an example of the care. And, it definitely influenced me because I think from the outside, people see, a successful guy, a wealthy guy. They don't necessarily see the work that, um, went into it. And maybe you get a sense I actually had him on my podcast, talking a little bit about his life story, what made him the way he was. But another example of that is I remember working on presentations. Anybody who's in finance, there's a lot of PowerPoints between you and the goal. And I remember walking into his office, and a lot of times my experience on the street was people just crank these things out, and he was gnawing on an eraser, which was or a piece of tape, I think, that was his classic thing, sweating over the wording of a single bullet point on the front page, and that tells you something, and it was that way with everything, and then I think the story I shared with you was Christmas cards being exhausted, on a trip, and, the some people mail out holiday cards, some people don't, but a lot of times it's pretty formulaic, like, "Happy holidays, thinking of you, wishing you all the best." No, detailed, long, involved, and so everything was like that, done with that degree of, care, and, I think it showed in the end result, and it's something that I took away, which is that, a little bit like, if you've ever trained intensely for a sport and you've been with people that are really that focused on the goal and you finish a workout, you're completely exhausted and they're like, now I'm going to the weight room for 45 minutes. And you're like, what? Like my whole body is saying, go home, lie down, close your eyes for 20 minutes. And they're like, no, 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 I want to get some. It was a little bit like that. And so, and I don't think in a way he pushed himself, but I don't, and, Ray, of course, would say, let him speak for himself. But I also think it was just sort of his natural, that's the rate at which he was comfortable operating.
That's great. So I also, I wanted to get into a couple of things. One of them is I was wondering if you could just say a few words about China. Now, I know there are things that you'd rather not get into, which is fine. I'm not going to ask you to do that. But it's a subject that comes up a lot on the podcast, and people wonder: should I buy these stocks? Should I buy Chinese stocks? Should I not buy Chinese stocks? I hear so many things.
Right. So how to so China, I think China's incredibly fascinating topic. And I think the key thing is the framing of China for investors. So the first thing is whether they invest or not, China is going to matter to them. And the reason is it's the second biggest economy in the world. And if you look at the volatility of the growth in China, so if you think about their growth contribution, because their ups and downs have been bigger than the US economy, which is the biggest economy, their growth contribution, in other words, the ebbs and flows of growth globally, China is responsible for more of that than the US is. And I think that matters, for instance, right now. In other words, why is inflation ebbing globally? where there's a lot of different parts to that. But I think one of the things is China is having a very, very weak post-COVID recovery. And so even if you're just trading the US stocks and bonds, or you're in Europe, you're just trading Europe stocks and bonds, the one of the reasons why commodity prices are so weak and inflation is so weak is because of what's going on with China right now. We could talk about what those dynamics are. So no matter what you do with China, you can't not pay attention to it. You need to understand how it's working. The second thing is I think having a good framework for growth is it's almost sort of like understanding the physics. Is that growth everywhere is income and borrowing, and so to understand on a forward-looking view what China is, you have to look at the nature of its income, how competitive it's going to be, what its population growth rate is going to be, what its productivity is going to be, and what its capacity is for taking on debt and spending. And I think in both these areas, income and borrowing, China's quite challenged right now. In other words, it has a shrinking population, and um, the debt level in aggregate, particularly for a still developing economy, is quite high. And so if you think about the capacity of taking on more debt or having a real productivity boom, I think it's quite limited. So if we're accustomed to China growing 5-6% range, I think the forward-looking picture is much weaker. So the first thing is it matters a lot. Second thing is have a logical framework for income and borrowing. And then the question is do you want these things into your portfolio? I think it really depends what your goals are and where you are. My message for investors inside China would be different from my message outside China. Um, the pro for having Chinese assets in your portfolio is that they have a positive expected return and that they're lowly correlated to the assets you have elsewhere in your portfolio. The con to me is right now geopolitical, which is that if you look at the way these systems work, China, the way I describe China is it has 5,000-year-old hardware. That's the culture. And then the software is basically Soviet. So if you think about the structure of the government, the person at the top, then an operating body, this is all basically Soviet software that they're operating on. And one of the key things with Soviet software is who, as they refer inside China, who person number one is really matters a lot. And for me, I think that the geopolitical situation right now is quite fraught. And I don't put things in my portfolio that I don't understand. And I don't understand right now what China's true intention is regards to Taiwan. I know what would happen if they moved on Taiwan, which is there'd be sanctions, et cetera. And so the key thing I ask for is, am I taking compensated risk or uncompensated risk? And to me, the risk premium on Chinese assets would have to be so high for me to do that, that when I look at the numbers there, I don't find it compelling as a US based investor right now. And that's very much influenced by my experience with trading Russian assets. I started my career in Russia, so I feel like I know the Soviet software well. And the Russian experience around Ukraine really influenced how I saw the cause effect relationships that can happen when a geopolitical conflict goes from one of words and sort of threats to actual actions. So I think China is fascinating. I have a lot of dear friends there. Um, I think that has so much potential to contribute to global growth. So I don't want to seem like I'm somebody that is sort of like a perma anti-China person. I'm just trying to be look at the facts in terms of expected return on investment. And right now, I'm personally not comfortable.
It seems to me when I think about these two countries, maybe I'm just a product of the past decades. Since I've been an adult, just say I'm 60ish now. So, the prospect of a war, of an invasion of Taiwan by China, it just I know it's real, but it just seems so otherworldly. It's something that I find difficult to accept that it could really truly happen. It's easy to say you could accept the Ukraine thing because we're in hindsight now. But even before, like the actions in the Crimea and so forth, there was a history there, right? This China Taiwan thing feels newer and somehow I want to say more extreme, more less likely.
Yeah. Well, I think you may be right, and also these things are dynamic. I mean, they're shifting over time. There's no question that I think that Zhongnanhai, which is basically a leadership complex there, is taking information about what happened in Ukraine and informing them about what could happen in Taiwan. When I went through, so going into the Russia incident or the invasion of Ukraine, I had held, going back years, I'd held positions in Russian stocks and bonds over various points in time. And what attracted me to them was that basically I felt like there was particularly, so what did they invade? They invaded in 22, so 2021, that there, I think about assets in terms of um, uh, what is the expected return on the asset and how does it compare relative to my alternatives? And if you looked at things like some of the Russian assets, take a classic example of Sberbank, which is the big state-owned bank there. It's a pretty well-functioning bank, and it traded at a massive discount relative to the dominant bank in the US, like JP Morgan. And it was literally banking is banking, and there was one here and there was another here. Moreover, from a portfolio standpoint, I always look at how I can combine assets together. And the thing I liked is that not only did you have a stock, which I thought was attractive, you could pair it with a Russian government bond, which was offering a pretty attractive yield. And I thought that if growth really weakened and you begin to get credit problems in Russia, that the stock would go down, but the bond would go up, and vice versa. Plus, there was a currency piece there. The Russian ruble I thought was relatively depressed. So I liked holding these in my portfolio ahead of that. But then, there began to be this troop buildup, to your point about the Chinese thing that could have happened. And I was like, this is nuts. Like, Russia has worked so hard to open up its capital markets and put in reforms and all these pipelines they've developed and the whole integration with Germany, blah, blah, blah. Like, this doesn't make any financial sense. And by the way, they know that the Soviet Union collapsed because of a bad economy. That was the presenting problem there. And then I called up my close friends, who were in Russia, and I was like, "What's going on?" They were like, "It's a bluff. It's a bluff. It's a bluff." So I thought about it. I said, "Well, the risk of these assets has just grown exponentially. So what is appropriate risk management? Well, you shrink them. So even though I liked these assets, I just shrunk the size of them." And then I read, more stuff going on. There's troop buildups. And then I'm thinking about like moving all these tanks and helicopters and the reports, and I shrunk it even further. And then finally, by like November of 21, I said, listen, I might be a little bit skittish here. But again, going back to the Taiwan thing, I can't predict what Putin is going to do. He's the only person that's going to make this decision. And as wise as my friends are, they don't know either. And so I cut the entire position. I had zero going in. And this is a huge thing to risk management, which is how heavily do you weigh low probability events that can crush you? It's a really, really tricky thing. And it's we could talk about this with stocks, et cetera, around depressions, et cetera. This is a huge issue, how much you weigh this. I know as an investor, having done this for years, I tend to be more skittish. But it's also what's led me to survive. I think I've had a low, steady return. And I've had a lot of situations where I've sold things like I sold in Russia needlessly, that I was too freaked out. But Russia is a classic case example where it saved my butt. Those people that have those assets, you cannot get them out. I don't even know if you could transact to them because you might violate sanctions and all sorts of stuff. Like, that money is gone. And I know people that have lost significant pieces of wealth due to it. So now play this thing forward to Taiwan. It also seems so strange to me. Like, China is not a wealthy country. If you get out of the major country, if you get out of Shanghai and Beijing and you're taking the train, you look out the window of the train, you will see peasants who are living very, very simple lives. And if I were in charge there, and I know a lot of the technocrats there, you'd be thinking growth, 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 growth. Don't pick a huge geopolitical fight. But if you actually read the statements of Xi, he seems to be very clear that he values reunification. So this is a situation where I know what I don't know. And if I can't predict that, I'm not willing to take the risk. So even if I agree with you, it's a low probability event, it's high enough, the consequences of it are such that I don't want to have it in my portfolio. And I try to take the simplest possible bets in a portfolio. I'm like, why trade complexity? Trade simple. Like, I want a simple idea that I can understand, and I can understand how that idea relates to other ideas. If I get into something like that that's too complex, I'm like, next.
Right. I'm glad you brought something up. This whole topic actually, the idea in both cases in Russia um, and in China that they may be motivated, highly motivated, it seems, by things other than economics, other than growth, as you mentioned, after seemingly doing like decades of work to get to a like they're not done. They decades of work to begin to get to a point where then you could grow some more, you know, and really meaningfully raise the standard of living of lots and lots of people, and then to do this.
Yeah, that's the other department story that I shared with you that maybe is worth sharing here, which is how does that work? And the answer is that in both places there's technocrats. This is the people that work at the central bank, at the Ministry of Finance, and the CSRC, and the Ministry of Economics in Russia. And many of these people are trained at top universities in the West. And if you talk with them, it's just like talking with people here. The outgoing now chief of the central bank of China, Yi Gang, is a former professor from the University of Illinois. And that's one department, and that's the reform department. But in both those places, there's a second department, and that department is the secret police department. And they operate according to a different calculus. And they're not the people going to Davos. They're not the people meeting with foreign investors. They're not the people doing all of that type of stuff. And that's the group that you're contending with. And that's the people that arrested the journalist, the Wall Street Journal journalist in Russia, Gerskovich. It's the people who would then, be leading to the arrests and the abductions in China. And so both these things are true. And the story I told you, the other department, is I was meeting with a senior official in China, and I was talking about, this was some years ago, about the abductions of the Hong Kong booksellers at the same time that they're opening their capital markets. And I said it sends a mixed message to investors because, on the one hand, these very thoughtful, articulate technocrats are saying, incorporate our stocks and bonds into your portfolio. They'll be so diversifying, blah, 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 blah. Makes sense. And then you're arresting. And he said the answer was, he goes, oh, that's a different department. So it's a different department that is a, and so that's the way they think about it. Like, I'm doing my technocrat stuff. Everything's lined up. Foreign investors are protected. But what about that other? And they're like, that's a different department. But as investors, we have to confront with both departments.
That is like that way of thinking. Look, I'm not saying we don't have bureaucracies in the West. We certainly do. We certainly
For
do.
sure.
But that level of this, it just like it seems so un-Western. It's like so
It
um
is.
it's crazy. It's something that you just can't wrap your. You're like, well, if they're arresting people, they disappear in the middle of the night.
Yeah.
Surely I can't buy shares in their bank or whatever. You know,
That's
it
Soviet
just
software. That's what that
yeah.
is. And that dates all the way back to beginnings of Russian history and Stalin's upbringing and how he was trained, et cetera. That's the remnants of that. And that's why I think that in terms of, particularly for the stuff that attracts me about investing, macro investing, yes, you need to be very rooted in fundamentals. What is the right framework for a stock? What is it for a bond? How do you think about inflation-linked bonds? What's a commodity, et cetera? But you also really need to be rooted in history and culture, I think, to have the whole picture. And
Mhm.
it's not easy. It requires a lot of homework, but boy, is it interesting.
Yeah, and what's another interesting thought I just had is that in a way, like, we're talking about these huge countries, China and Russia, and it's sort of, this is emerging markets 101, isn't it? Figuring out if now, are the secret police gonna be a problem? You know, I is the dictator who appointed himself for life gonna be a problem? Because they have these really great businesses there. It's just such a juggling act, and it's easy to dismiss it and say it's not worth doing it, isn't it?
Um, yeah, though I think it depends on how you a little bit define emerging markets 101. In other words, I think the classic EM story is the country that was um, a little bit more Rick. I mean, the classic story would be like a South Korea or Singapore or something like that, that at times seemed more rickety and then developed a more robust, very investor friendly framework. And if you're owning that, you basically saw a secular increase in the PEs. But I think what we're talking about in Russia and China is a little bit more of an opening up and then a closing down.
Right. That is so strange. We all had this idea like China was gonna be this great power, and it may yet be, but, I don't know. I find it I guess I'm where you are, Paul. I can't wrap my head around it. I can't put a dime into it, is really where I
Yeah.
am.
Well, I think that I've thought about it a lot, and I think the thing, I mean, to step back, is that the process of modernization, like if you look at the last couple of hundred years, basically productivity is essentially, in the early part of the 18th century, not that much changed from the Roman Empire, and then you get this, this huge rapid shift that we're dealing with now. And that puts enormous strain on governing systems and cultural systems to adapt. And I think that the thing that both Russia and China are going through is particularly China, is it's an ancient culture. And adapting that to modernity is a very stop start, slow process that has to do with authority and rule of law and education and all these things. And it does not move in a straight line. There could be big ebbs and flows. And I think we were formative part for my career was the Berlin Wall falling and all that excitement. I remember being in Russia there, watching all those changes. And, we got a shift in one direction. But then I think particularly 2008 um, was a big rattling of their confidence in that model as being appropriate for meeting their goals. And you began to see a shift in the other direction.
Right, so, in terms of maybe decades, you're describing, 2 steps forward, 1 step back, and maybe appointing
Exactly.
oneself dictator for life and, invading the Ukraine
Yes.
and so forth. This is 1 step back, each of these large.
Exactly, and if you think about it, the scale of things, like, is Putin a war criminal in Ukraine? I think it's unequivocal. I think, yes. I'm not a lawyer, but I think if you look at the evidence, yes. At the same time, if you look at how many people Putin has killed compared to how many people Stalin has killed, he's a much milder variant. And so, it's strange to look at it that way, and I would be scared to be in Russia right now, and I would have been terrified to be there under Stalin. But, maybe it's a less, virulent form of the same thing.
Right, so what are the odds? It seems to me like both Xi and Putin die in office. I mean, they're both there for the
I think
duration,
so.
and maybe, the way Putin's going, who knows how long that could be, um and then what happens? I mean, that becomes doesn't that be that becomes an even almost worse situation. A country like that in that kind of turmoil.
I think it depends. It's hard to say. It's hard to say. I think with each of these things, if you think back over longer time frames, the 20th century is basically a debate about two things. What is the optimal governing model for a place? So communism versus, top down versus democracy. And then what is the optimal economic model for a place? I think the collapse of the Soviet Union ended the second debate. I think that people basically agree that if you want to create growth, you need to have the system. So that is a huge step forward, actually, I think, for just creating well-being for people. I remember when I was first in Russia, when I was I moved there right after college, and I was talking with this woman, and she it was like one of these moments. 6 year behind, she's, first of all, it's like 8 in the morning. She's dragging on a Marlboro for breakfast with a cup of coffee, and I was like very naive at that point, and I was like, what's it really like to live here, etc. And she goes, Paul, they tried to build socialism in the desert. And I said, yes. And she goes, do you know what happened? And I said, no. She said, they ran out of sand. And so her point is that these systems produced unbelievable shortages of incredibly basic things. And I think that has been well established. And so what happens when these people go? Well, it's hard to predict, but I think that the question is, the big debate right now is, what is the optimal operating system of the governments? to produce a system that works out for the majority of its participants. And I think that both what the Kremlin and Zheng Enhai would say is that the Western system has all these defects, and they could go through them. We could talk about them here, and and that the West would have a different answer for that, which is that it has huge defects, but it has the ability to debate and improve on them. So the question is when that collapse comes, how do these two people move forward? And I think they'll be faced with that situation. The move to a more market-based economy, I think, is unequivocal. And then the question is how far they move in that other direction, and if you believe it.
So we've talked about these two places, and I thank you for sharing like facts and also process about basically things you don't know, things you can't know. Really valuable. I was reading a bit about a piece about Chile that you had here on your Substack called "Letter from Santiago," just before we started recording, and maybe we should talk a little bit about that country as a place. Are you more comfortable? Do you feel there's less that you don't know about Chile, maybe than about what Xi or Putin are going to do?
Well, I feel like I know enough about Xi and Putin not to invest in there, so that's already something. It simplifies your life. There's lots of other good stuff to invest in. In terms of Chile, I went down there. I'm a big believer of doing lots of homework, but also seeing things firsthand. That's actually something that I learned and was reinforced by working with Ray. And Chile obviously is going to be the center of the production of a lot of raw materials that are critical for one of the big shifts that's underway, which is the shift to electric vehicles. And I just wanted to see if this was going to improve the country or not. If you look at Chile, there's no reason really why it shouldn't be as wealthy as like a Norway or Australia. The structure of the country is very similar. It's small populations sitting on top of a lockhold of commodities, but it's not that way. And doesn't have the wealth of a Norway or Australia. And one of the reasons is because of these incredibly strong shifts between left and right there, which they're in the middle of right now. And shortly after I was there, the current administration came out and talked about nationalizing or pseudo nationalizing one of their key private sector lithium exporters. So I think that uh, Latin America is another part where this global debate over the optimal system is playing out, and Chile is part of it, but you can see it all over. And El Salvador being a classic example there, where I wrote about this too. This is sort of having a hipster dictator there that has abandoned civil liberties, but also seems to be having incredibly high popularity ratings. So this broad debate, which we also see in the United States, of will the system deliver rewards to enough of the people to have confidence in the rule of law, is what's going on in Chile, and it's what's going on globally.
Does this make Chile uninvestable at this time?
I don't think it makes Chile uninvestable, but there's a question of if what's the degree of diversification it's going to get you relative to what you can get in existing assets. And again, back to I have a very small exposure to Chilean assets right now, but the question is can you are there simpler ways of you being able to earn your return? And I think there are right now. So I look at what's going on in the United States, and there's a significant tightening of monetary policy. I know you've talked about it a lot on your show, and to my mind, a very rapid falling in inflation. And so, over relative to the past, I mean, I could look at Bloomberg to remind myself of the time frame, but you you can get 5% for sitting in cash right now. So a lot of people are very happy to earn 8-9% returns. Okay, you can get the first 5% of that by taking no risk. Like if you own 5% 2-year notes and hold them to maturity, your risk is zero. You're gonna get paid 5%. And so it doesn't take that much work to build a portfolio on top of that. I think they can get you 8 or 9% with these types of cash rates with not that much risk. So to me, the relative merits of throwing it at Chile or the other things, it all depends on the alternatives. And I actually think that right now, what's happened in the world is uh, we had this pandemic. It was a massive disruption. It caused inflation to spike within the context of relatively deflationary forces globally. Going into this, we had hyper-competitive technology that's only gonna get more competitive. AI and lots of other ways of trying to outsource and squeeze margins out of things. Any business with middlemen in them is systematically getting destroyed, and that is actually very, deflationary. And so we had this huge spike up. The Fed and other central banks were very slow to realize what was going on, and now we've had the pendulum swing into a pretty significant reaction, to my mind, now verging on overreaction in the other way. In other words, inflation in the United States has fallen from 9 to 4. PCE is now down at 3.8. If you look at just the morning we're talking, I don't know when this is gonna be aired, but ISM prices paid now fell the lowest it's been since the pandemic. And so you've had this huge swing, and I think that it's creating the situation that is actually very favorable for investors, in the sense that trying to build a great portfolio when real interest rates were negative, which is what they were for many years, relative to now, you can build one where short-term treasuries are offering you a real yield that's 2%. That's much more favorable for investors. I just think of investing as basically renting out your money, and the rents are a lot higher now than they used to be.
Oh, interesting way to put it. Yeah. So it sounds like you you like the U.S. and
Yes.
we don't need to mess with we don't need to mess with Russia and China and Chile to get a
I
really
don't
good
think a
return.
lot. I've got a, I've got maybe a couple percent of my portfolio right now in emerging market. That'll expand or contract, but right now I'm not seeing that particularly compelling relative to the alternatives that are closer at hand.
All right. Um, you know what I think? I think it's actually time for my final question. Which, yeah, it's the same question for every guest. And like, even if we have a guest that is a non-financial topic, we had a sort of a health and fitness guru on here one time, and a couple other different folks. We had Ron Paul on once. Everybody gets the exact same final question.
I like that.
Yeah, very simple question. The question is simply, if you could leave our listeners with one thought today, what would that be? What would you like to
Um,
leave them with?
Follow your curiosity. Listen to it. Because if you there are hints there, and a lot of times those hints come from, different parts of your brain, but you gotta listen to it. One of the most influential essays, I know I've been a little bit long in my answers today, but one of the most influential essays I read, was by, there's an American novelist recently died, Cormac McCarthy. I don't know whether you've read his work. So he wrote, to my mind, one nonfiction essay, and it's called The Kukuli Problem. You can get it. I think you can Google it and get it. But it's basically, and there's an interview you can find on YouTube about it. I thought it was quite fascinating. It basically said that there's not much we understand about our unconscious, but our unconscious will solve basically any problem we give it. And one of the things I think you have to give it is like, what are you genuinely interested in? In other words, you clearly enjoy these conversations and drawing people together and stuff like that. And I think that one of the keys for fulfilling life is really listening to what you're genuinely curious in and following that. And that leads to all sorts of unbelievable openings. And I feel like it's only gotten better over time. So macro investing, when I started out, I literally didn't know what the difference was between a future and a cash market. I had no idea. And that was like a little thing. And then it just kind of opened up and got more complex and deeper over time. But it was all just following curiosity. And when I talk with young people, a lot of times they come out of school and they're focused on, how they did in this class or that class and stuff like that. And I'm just like, what were your extracurriculars? What type of conversations are you having with your friends? Hone in on what that thing is that you're actually really, really deeply curious about. And I think that'll lead you to a good place, whatever that place is.
Wow, that was a really fantastic answer. This is something that has impacted my life directly, and just by to me, it's pausing and breathing and thinking, just what is really going on in me? What am I really feeling about this? What do I really want to know? And what I'm doing, I think you would say, is I'm letting my curiosity well up, and I want to
Yes,
be able to
exactly.
identify it.
Yes.
Allow it, just to allow it, because I've gone through my career thinking, "What am I supposed to do here?" And I
Yes.
and we were in school, and what answer are we supposed to give here?
Yes.
That's not
As
real
opposed to what
learning.
answer is there.
Yes,
And if you just
yes,
listen to it,
Exactly. What is the answer? Not what do they want me to say? What is the
Yes.
answer? Or an
Yeah.
answer, because there's no the
Yeah.
answer usually.
And then when it wells up, it's crazy positive. So probably over time here, but when I left Bridgewater, it was a little bit of, I was used to working in that structure, and Ray was the dominant influence. And I was like, what is it? One of the things for me is writing for me is like breathing. Like I can't not write. I realized, even if I had a reader of two, I can't not write. And so that writing led to the Substack, which then got me invited to that conference, which then led me to connecting to you today. And all that was like I had no idea that you existed. But all that had to do with me following that curiosity. Like I can't think without writing, and if I write this thing, I'll share it, and then we'll just see where it goes. And there you go.
It's interesting that you say that about writing, because our host at Value X Vail is a very much, he writes every day, Vitaly Katzenelson. He's been on the show 3 or 4 times and is a big advocate of writing. And for me, um, I think better when I write, because you can't escape it. It's on the page staring back at you, and you really have to think about it.
And there's this powerful thing, both conversations and I think writing, they
Mhm.
help draw that thing out, whatever it is that's buried in there. Like, what is the question?
All right. That was a great answer. I thank you for it, Paul, and thanks for being here. I really enjoyed talking with you.
Sure. Thanks so much for your time. Talk to you later, Dan.
All right. Many mainstream analysts are predicting that stocks will recover soon, but I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report. I'm really glad that we had Paul on the show. His comments on China and Russia and the process by which he sort of assessed the risk, that whole discussion of what's going on in those countries and how he thinks about the risk is really very, very important. And I think we talk a lot with a lot of investors about a lot of things, and we talk about a lot of different countries. Um, and it rarely, occasionally, you get somebody who really provides you with more than just a stock pick or even an idea about how to pick a stock. It's a framework and you heard when he started talking, he said, the framework is important. And that's what he gave us. It's a very important way of thinking about things. And the whole bit about, you know, the way they think about things in China and Russia, everything's in a different department. There's the economic growth department, and then there's the secret police making people disappear department. And to our Western ways, that is just so weird, and the way things are now, like we said, they've taken a couple steps forward. Maybe they're taking a step back for a few years here, and then we'll see, how things come out in the next several years in those 2 countries. And of course, we talked a little bit about Chile. I think um, I'm I'm probably more interested in Chile than Paul is. I didn't really get into it. I didn't want to get into a debate about it. I just wanted to know what he thought, um, because again, um, the idea that Xi and Putin are so focused on things that could hamper the important economic, uh, you know, progress that they've made over a period of decades, it just seems a little crazy to me. And I suppose the same thing could certainly happen in Chile if they nationalize the lithium mines or whatever. Um, but I think what's happening there is like, is Chile really going to go as far as shooting themselves in the foot or in the head, really? If they mess with the copper mining, that's shooting themselves in the head. I mean, that's their economy. That's a huge, huge part of their economy. They're the number one copper producer. So I would think that if the rhetoric really ramps up there and, they start talking about nationalizing the copper, that I don't know if it'll ever actually happen. Um, but you can probably safely avoid Chile and just invest in copper anyway, because we're going to get the demand for it, and we don't have the global supply to meet all this new demand. And if some problem happens with the supply in Chile, guess what? That's just more supportive of prices. So there's a lot to think about. And I like the fact that Paul underscored that you can't be an investor today without having some view about China, without understanding how it impacts global financial markets. Really great stuff. I really enjoyed that. All right, so that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. Make sure to follow us on Twitter. Our handles are @Stansberry and @investor_hour. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.